A futures contract is an agreement to buy or sell an asset at a specific price and date in the future. For instance, Alice and Bob can create a contract where they commit to trade one Bitcoin for $10,000 at the end of the year. So, if Alice is on the buying side, Bob must sell one Bitcoin to her at the settlement date for that specific price. This means that if Bitcoin is trading above $10,000 by the end of the year, Alice will pay less than the actual market value, so Bob loses money and Alice makes a profit. But if Bitcoin is below $10,000 at the settlement date, Bob profits and Alice loses. In this example, they would only trade Bitcoins at the settlement date. In most cases, though, they don't really trade Bitcoins, but only the equivalent value in cash. This is what we call a cash settlement. Note that the settlement date is defined when the contract is created. It can't be changed. Still, Alice and Bob can buy and sell futures contracts multiple times before they expire, and the price of each contract varies according to the market supply and demand. So Alice can buy one contract for $10,000 and another one for $10,500. She could then hold these contracts until the settlement date, or sell them to someone else for a shorter-term profit. Futures contracts are derivatives, which means their market price is derived from an underlying instrument. So, unlike traditional spot markets, you don't really trade assets, only contracts that represent them. As such, the exchange of contracts can happen several times prior to the settlement date, but the actual settlement happens only once for each contract, after they expire. But did you know there's a special type of futures contracts that simply don't have a settlement date? These are the ones we call Perpetual Futures Contracts. With Perpetual Futures Contracts, Alice can hold a position for as long as she wants, given the minimum requirements are met. There are three central concepts at the core of Perpetual Futures: initial and maintenance margin, liquidation, and insurance fund. Let's take an example of Perpetual Futures trading to understand these concepts. Suppose Alice has 100 BNB and she uses them to buy 1000 BNB at 10x leverage. In this case, the 100 BNB acts as collateral and is what backs her position. This is what we call the initial margin. But after opening a position, Alice wants to make sure her position stays open, and that's where the maintenance margin comes in. The maintenance margin is a dynamic value that changes according to the asset's market price and to the total balance of her margin account. Summing up, the initial margin is the amount Alice commits when opening a leveraged position, and the maintenance margin is the minimum value required for her to keep all positions open, in this case only one. So if Alice's balance drops below the maintenance margin level, she will either receive a margin call or be liquidated. If Alice receives a margin call, she'll be asked to increase the collateral by adding more funds to her account. But margin calls aren't common in the cryptocurrency space. In fact, most exchanges rely solely on a liquidation mechanism. In short, liquidation is the forced closing of leveraged positions. It may occur when the total value of a market account falls below the maintenance margin, meaning that the collateral is too low. In some cases, open positions will be closed and all holdings will be liquidated, leaving the account with zero balance. In other cases, a trader may experience a partial liquidation, which involves the reduction of open positions and the liquidation of some of their assets. Still, each trading platform has a unique system for perpetual futures contracts, so the liquidation mechanisms vary from one exchange to another. Along with liquidation, the insurance fund is another important concept of perpetual futures markets. Simply put, the insurance fund is what prevents the balance of losing traders to drop below zero. It also guarantees the winning traders get their profits. To illustrate, let's suppose Alice has $2,000 in her Binance Futures account. She uses her entire balance to open a 10x BNB long position, paying $20 per contract. Note that she is buying contracts from another trader and not from Binance. So let's assume Bob is on the other side of the trade, with a short position of the same size. Because of the leverage, Alice now holds a 1000 BNB position valued at $20,000. However, if the BNB price drops from $20 to $18, Alice could be liquidated. In that case, all her open positions would be closed and her $2,000 collateral entirely lost. But let's imagine that, for whatever reason, the system isn't able to close Alice's positions on time and the market drops even more. That's where the insurance fund comes in play. The insurance fund protects the system against unpredictable and abnormal market conditions. In this case, it's activated to cover the losses generated by Alice's positions, which couldn't be closed on time, so the system had to pay extra money to finally close her positions. This doesn't change much for Alice because she was liquidated and her balance is now zero, but it ensures that Bob is able to get his deserved profit. Without the insurance fund, Alice's balance wouldn't only drop from $2,000 to zero, but could also become negative. A negative balance could lead to at least two undesired outcomes. 1. Alice would be asked to add more funds to pay her debt. Or 2. Part of Bob's profit would be used to cover Alice's negative balance. So, the insurance fund is a mechanism designed to prevent those situations. It uses the collateral taken from liquidated traders to ensure that users don't get negative balances. To learn more about economics, blockchain, and cryptocurrencies, check out our other videos at Binance Academy.